Welcome to Finan Simple, where money is made easy. And in today's video, we'll be presenting the top 7 monthly dividend ETFs that you should buy to start generating passive monthly income. What are you waiting for? Let's get started. Starting off with number 7, SPHD, also known as the Invesco S&P 500 High Dividend Low Volatility ETF. It is based on the S&P 500 Low Volatility High Dividend Index, which measures the performance of the 50 least volatile high dividend yielding stocks in the S&P 500. A total of 52 equities make up SPHD's holdings, with Altria Group, Kinder Morgan, AT&T, and a few other less well-known businesses ranking among its top holdings. SPHD has provided an annual return of 9.09% for the previous 10 years. In other words, if you had put $10,000 into this ETF 10 years ago, your investment would now be worth a little more than $22,000, not counting dividends. Speaking of dividends, this ETF has now a dividend yield of 3.97%. You will need to pay what is known as an expense ratio. Fortunately, SPHD has the list's lowest expense ratio. For every $1,000 you invest in this ETF, you only pay $3 in annual fees at a rate of 0.30%. Up next for number 6 is PGX, or the Invesco Preferred ETF. It is based on the ICE BofAML Core Plus Fixed Rate Preferred Security Index and measures the performance of fixed rate U.S. preferred securities. Preferred securities typically offer higher dividend yields than conventional fixed income securities, which makes this situation special. PGX has only returned roughly 3.86% annually over the previous 10 years. Accordingly, $10,000 invested in this ETF 10 years ago would be equivalent to $14,000 now. For dividends, this ETF has the highest dividend yield on the list so far at 6.11%. The price is represented by a 0.51% somewhat higher expenditure ratio. Every $1,000 you invest in this ETF will cost you $5.10 in annual fees. Number 5 is DIV, also known as the Global X SuperDividend US ETF, a highly well-liked high dividend yielding ETF that tracks the index SuperDividend US Low Volatility Index. It monitors precisely 50 evenly weighed high dividend, low volatility equities. Some of the top holdings among the 50 equities this ETF owns are corporations like Sabine, Kellogg, and IBM. It has produced an average annual return of roughly 2.95% since its debut in 2013, meaning $10,000 invested in this ETF in 2013 would be worth about $14,000 in today's dollars. One dividend that you wouldn't want to invest in it is the OILK ETF, which offers a mind-blowing dividend yield of 71.15%. But if you look up a statistical graph of the said dividend, there is hardly any growth taking place. This ETF's dividend yield is now 6.57%, and it has an expense ratio of 0.45%, meaning that for every $1,000 you invest in it, you'll pay $4.50 in fees annually. After all, even household names like Apple, huge international institutions like Goldman Sachs are advising their clients to allocate less money to stocks and more to low correlation assets like real estate. Morgan Stanley identifies one real asset that is currently performing better than even its pre-pandemic levels, while the typical bond stock portfolio has lost about 20% this year. Fine art has been able to buck the general trend of other investments toward decline because, according to Citi, it has a very low and occasionally even negative correlation to other investments. How exactly do you invest in art? You can achieve that with Masterworks. Since the artworks were divided into portions, you don't require millions. To identify artists with the greatest potential for recognition, their team of art specialists uses confidential data. The evidence is already in plain view. In August, Masterworks sold an Albert Ollin artwork for a 33.1% net return to their investors. At that time, the S&P 500 had almost 28% of its value for the year. Anyways, moving on to number 4 is SRET, or the Global X SuperDividend REIT ETF. It tracks the selective Global SuperDividend REIT Index, which analyzes the performance of the highest yielding REITs worldwide. A real asset investment trust, or REIT, is a business that owns and manages properties that generate revenue. SRET now owns 28 different equities, the majority of which are held by less well-known corporations, including Capital Land, W.P. Carey, and Getty Realty. You see, by law, REITs must distribute 90% of their taxable revenue each year to shareholders in the form of dividends. As a result, SRET has a magnificent dividend yield of 8.44%, which is about 2% greater than DIV. You can anticipate paying roughly $5.80 in annual fees at a rate of 0.58%. Number 3 on the list is KBWD, also known as the Invesco KBW High Dividend Yield Financial ETF. It follows the KBW Nasdaq Financial Sector Dividend Yield Index, a dividend yield weighted index made up of U.S. financial businesses with high dividend yields. A total of 40 stocks are held by KBWD as of early November 2022, including several top holdings and several financial institutions that you probably won't be familiar with, such as Armor Residential, Broadmark Realty Capital, Ready Capital, and dozens of other companies in the financial sector. Comparing this ETF to something like VUG, which is an average annual return of roughly 13%, it is not a strong performer in terms of performance. It has produced a 4.67% yearly return on average since its debut in 2013. This means that if you had invested $10,000 in 2013, it would have only increased to a little bit over $13,000. However, this ETF makes up for its lack of growth with a delicious 11.18% dividend yield, the highest on the list thus far. For every $1,000 you invest, you'll pay around $25.90 per year at 2.95%. Now, this ETF's dividend yield is 11.18%. For number 2, QYLD, or the Global X Nasdaq 100 Covered Call ETF. It aims to deliver investment outcomes that are consistent with the performance of the CBOE Nasdaq 100 Buy Right V2 Index, a benchmark index created to track the performance of an idealized buy right strategy for the Nasdaq 100. Simply put, as the name suggests, this ETF makes money by writing covered calls. A covered call is an option strategy that yields more money when volatility is high. You understand that this video is not intended to teach you how to use options. But it should be emphasized that, in contrast to all the other ETFs on this list, this ETF has a very distinct strategy for generating income. The good news is that the cost ratio is only 0.6%, which means that for every $1,000 you invest, you'll only have to spend $6 annually. Now, for the number 1 ETF, JEPI, or the JPMorgan Equity Premium Income ETF, has topped all on the list. JEPI is an actively managed ETF that invests in both US big cap stocks and equity-related notes. Its objective is to give investors exposure to the stock market generally, but with reduced volatility and monthly dividend income. With an average annual return of roughly 9.89% since its debut, $10,000 invested a few years ago would be equivalent to nearly $12,000 now. The returns of JEPI would more closely resemble this chart of VOO or VTI if we compared it to an ETF with averages comparable to those of JEPI and then extended the time horizon to 10 years. What about dividends? Although it now has one of the lowest expenditure ratios on the list, 0.35%, its dividend yield is just 10.79%. Only $3.50 will be due annually for every $1,000 invested. Those were the 7 monthly dividend ETFs that you should definitely consider investing in to start making a portfolio of passive income. Do you have other options that you consider on your list? Let others know and help them build their own portfolio of investments to choose from. Always stay focused on learning and developing discipline. Get educated, make a plan, and stay the course. If you found this informative, smash the like button, please share it with a friend, comment down below, and let us know what would you like to have made Finan simple next. And definitely subscribe so you don't miss new content. Keep your head up, ears open, and always search for knowledge. See you soon!